ChatGPT, Claude, Gemini, Grok, ask them the same question. You get the same answer. The AI model war is over. These models are commoditizing. They are functionally interchangeable. The next wave of AI multimillionaires will not come from investing in the companies building these models. OpenAI, Anthropic, Google, xAI are in a price war, not a profit war. Margins are compressing. The models are converging. So where does the real money go? Hyperscaler AI capex is on track for $725 billion in 2026. That money does not flow to the model companies. It flows to the infrastructure underneath them. Every AI model on Earth is bottlenecked by 5 things. Chips. You cannot make enough cutting-edge processors fast enough. Cooling. Data center racks running 100 kilowatts plus are overheating and breaking traditional cooling. Water. AI is consuming fresh water at rates that are hitting municipal limits. Power. Electricity demand from AI is growing 165% by 2030, and the grid cannot handle it. Networking. GPUs and clusters wait on data more than they compute. These 5 bottlenecks are where the $725 billion flows. The investors who got rich in phase 1 bought Nvidia before the AI boom. The investors who will get rich in phase 2 will buy the companies solving these 5 bottlenecks. Some of these companies are completely unknown to retail investors. Some have deeper moats than Nvidia. Some are sitting on 3 to 5 year order backlogs with locked-in hyperscaler customers. In this video, 10 established infrastructure companies ranked by a 4-metric framework. 3 emerging small-cap companies with multi-bagger potential. And the exact framework so you can find additional companies I did not cover, because these 13 are not the only ones solving these bottlenecks. Welcome back to Faceless Millionaire. The AI infrastructure space is where the real wealth is being created right now, not in the model companies. In the companies solving the physical constraints blocking AI from scaling. Subscribe because this channel breaks down investment opportunities with real math and honest frameworks. Important disclaimer. I am not a financial advisor or stock analyst. This is educational research on AI infrastructure using a public evaluation framework. Every stock mentioned carries risk, including total loss of your investment. Past performance does not guarantee future results. Verify all financial data independently before investing. Do your own research. This is not personalized financial advice. Individual companies mentioned are for educational analysis, not recommendations. The 5 bottlenecks choking AI scale. Brief overview before we dive into the companies solving them. Bottleneck 1. Chips. ASML is the only company on Earth making UV lithography machines that cost $150 to $180 million each. Every cutting-edge AI chip from Nvidia, AMD, Apple, or anyone else requires ASML equipment. It is a 100% monopoly with a 3+ year order backlog. No alternatives exist. Bottleneck 2. Cooling. Traditional air cooling cannot handle the 800 kilowatt plus GPU racks that AI requires. Liquid cooling is now mandatory for every new AI data center build. The liquid cooling market was $6.6 billion in 2025 and is projected to reach $29.5 billion by 2033. That is 4.5 times growth in 8 years. Bottleneck 3. Water. Google consumed 8.5 billion gallons of water for cooling in 2022, up 50% from 2019. Microsoft's AI data centers use 300 times more water than traditional server facilities. Fresh water is becoming scarce in the exact regions where data centers are being built. Arizona, Texas, California. Closed-loop water recycling is the emerging solution. Bottleneck 4. Power. A single hyperscaler AI data center requires 500 megawatts plus of capacity. That is equivalent to powering a city of 500,000 people. U.S. electricity demand is growing faster than at any point since the 1950s. Nuclear is the only carbon-free option that can reliably deliver at that scale. Bottleneck 5. Networking. An H100 GPU computes at 1 petaflop, which is 1 quadrillion operations per second. But the network connecting GPUs to each other runs at only 400 gigabits per second. The GPUs sit idle up to 80% of the time, waiting for data to arrive over the network. Ultra-high-speed optical interconnects are the constraint. The industry is moving from 400 gigabit to 800 gigabit to 1.6 terabit speeds. These 5 bottlenecks determine whether AI can actually scale to the next level. The companies solving them will capture hundreds of billions in annual infrastructure capex. Before looking at any company, you need a framework to evaluate it. This 4-metric scoring system works for any AI infrastructure stock. It is evergreen, repeatable, and you can use it to find companies I did not cover in this video. Metric 1. Monopoly position scored 1 to 10. Can customers realistically switch to someone else? 10 means only provider, like ASML, where no alternative exists on Earth. 8 to 9 means dominant with 1 to 2 small competitors, like Vertiv and cooling or Arista and hyperscaler switching. 6 to 7 means oligopoly with 2 to 3 players sharing the market, like Synopsys and Cadence in chip design software. 4 to 5 means competitive market with many players. 1 to 3 means commoditized like AI models, where users switch freely. Why this matters? Monopolies have pricing power and can raise prices 10 to 20% annually. Competitive markets have price wars where prices fall. Over 10 years, a monopoly compounds into 2 to 3 times your investment. A competitive company often destroys value. Metric 2. Order backlog scored 1 to 10. How many years of revenue are already committed and growing? 10 means 3+ years of backlog growing 20% plus annually. 8 to 9 means 2 to 3 years. 6 to 7 means 1 to 2 years. 4 to 5 means less than a year. 1 to 3 means no backlog and spot market revenue. Metric 3. Customer lock-in scored 1 to 10. Is revenue locked into hyperscaler capital expenditure plans? 10 means locked into 5+ hyperscalers with multi-year commitments. 8 to 9 means 3 to 5 hyperscalers. 6 to 7 means mixed customers. 1 to 5 means spot market or general enterprise. Hyperscaler capex is the most stable capital expenditure in the world. Google, Microsoft, Meta, and Amazon will spend hundreds of billions on AI regardless of economic cycle. Metric 4. Capex flow-through scored 1 to 10. Of the $725 billion in AI capex, how much flows directly through this company's profit and loss statement? 10 means captures 20% plus of infrastructure capex. 8 to 9 means 10 to 20%. 6 to 7 means 5 to 10%. 4 to 5 means 2 to 5%. 1 to 3 means less than 2%. Total possible score, 40 points. 35 to 40 is exceptional. 30 to 34 is excellent. 25 to 29 is good. Below 25 is selective or speculative. You can use this framework on any company that claims to be an AI infrastructure play. Score it across all 4 metrics using publicly available financial data. If it scores 30 plus with verified data, it deserves serious research. If it scores below 25, proceed with extreme caution. Company number 1, ASML. Bottleneck, chips and lithography. Framework score, 40 out of 40. Perfect score. Market cap approximately 400 billion. Revenue 27 billion euros in 2023. ASML is the only company on Earth that makes UV extreme ultraviolet lithography machines. These machines print the patterns on silicon wafers that become every cutting-edge AI chip. 100% monopoly. 3+ year order book with approximately 200 billion euros in committed orders. Each machine costs 150 to 180 million. Every cutting-edge AI chip from Nvidia, AMD, Apple, or any hyperscaler's custom silicon requires ASML equipment. The customers, TSMC, Samsung, Intel, and SK Hynix, are also shareholders in ASML. They are literally invested in ASML's success and cannot switch because no alternative exists. Canon and Nikon each spent over $1 billion trying to compete and failed. The barrier to entry is 10 billion plus and 20 years of R&D. ASML is the gold standard. Every other stock on this list should be measured against ASML's moat. Company number 2, Constellation Energy, ticker SEG. Bottleneck, power generation. Framework score, 38 out of 40. Market cap approximately 80 billion. Revenue 11 billion. Constellation operates 15 nuclear plants in the United States with 12 gigawatts of total capacity. The Microsoft partnership is the killer signal. Microsoft is committing over $1 billion to restart 3 Mile Island specifically to power AI data centers. Nuclear is the only carbon-free option that can reliably deliver 500 megawatts plus at scale. Solar requires massive land footprints. Wind is intermittent. Nuclear runs 24/7. And critically, no new nuclear operating licenses are being issued in the United States, which means existing nuclear operators like Constellation have a monopoly on licensed generation capacity. Microsoft committed $1 billion plus to restart a nuclear plant specifically for AI. That tells you everything about how desperate hyperscalers are for reliable power. Company number 3, Arista Networks, ticker NET. Bottleneck, networking. Framework score, 37 out of 40. Market cap approximately 140 billion. Revenue 7.3 billion for fiscal year 2024. Arista holds 80% plus market share in hyperscaler data center switching and is actively displacing Cisco, which is losing ground. Multi-year order backlog with the top 5 customers representing approximately 50% of revenue, all hyperscalers. Every AI GPU cluster requires Arista switches to connect thousands of GPUs together. As GPU clusters scale from thousands to hundreds of thousands to millions of GPUs, networking demand scales proportionally. Arista is doing to Cisco what Cisco did to legacy networking companies in the 90s, except Arista has the $725 billion in hyperscaler AI capex as a tailwind. Company number 4, Coherent, ticker CORE. Bottleneck, networking and optics. Framework score, 35 out of 40. Market cap approximately 15 billion. Revenue 3.6 billion. Coherent makes the actual optical components that go inside networking equipment, lasers, receivers, transceivers, the physical pieces that convert electrical signals to light and back, even more specialized than Arista. Coherent sells to Arista, to Meta, to Google, to every company building optical networking for AI clusters. Near monopoly position with Infinera in optical components. AI-driven demand is surging because every GPU cluster needs faster and faster optical connections. Arista makes the switches. Coherent makes the lasers inside the switches. Without Coherent's optical components, Arista's switches literally do not function. Company number 5, Vertiv, ticker VERT. Bottleneck, cooling. Framework score, 34 out of 40. Market cap approximately 50 billion. Revenue 6.5 billion. Vertiv is the market leader in data center cooling distribution units and is expanding aggressively into liquid cooling through acquisitions. CDU lead times have stretched to 6 to 12 months because demand far exceeds supply. Hyperscalers are buying every cooling distribution unit they can find. Cooling is the physical constraint that everyone underestimates. You can buy all the GPUs you want from Nvidia. If you cannot cool them, they thermally throttle, and your AI cluster runs 20 to 40% slower than it should. Without adequate cooling, you are burning hundreds of millions in GPU hardware to run at half capacity. Company number 6, Eaton, ticker ETN. Bottleneck, power hardware. Framework score, 32 out of 40. Market cap approximately 120 billion. Revenue, 20 billion. Eaton makes the electrical distribution hardware that sits inside every data center. Switchgear, uninterruptible power supplies, busways, and power distribution units for every server rack. Recently acquired Boyd Thermal to add liquid cooling capability to their product line. Data center segment growing 25% plus. Diversified customer base that includes hyperscalers plus enterprise plus government. Every rack and every data center on Earth needs Eaton power hardware. It is the unglamorous plumbing that makes everything else in AI work. Company number 7, Synopsys, ticker SNIPS. Bottleneck, chip design software. Framework score, 31 out of 40. Market cap approximately 80 billion. Revenue 6.6 billion. Synopsys and Cadence together own 80% plus of the chip design software market. It is a duopoly. Every AI chip designed globally uses Synopsys tools. Nvidia designs with Synopsys. AMD designs with Synopsys. Apple, TSMC, Samsung, every custom chip being designed by hyperscalers for their own AI infrastructure uses Synopsys. Subscription model means recurring revenue with high visibility, gross margins above 80%. Before ASML can print a chip with their lithography machine, Synopsys must design it. They are the very first link in the entire chip supply chain. Company number 8, Quanta Services, ticker PWR. Bottleneck, power infrastructure and delivery. Framework score, 30 out of 40. Market cap approximately 50 billion. Revenue over 20 billion. Record $44 billion backlog. Quanta builds power generation facilities, high voltage transmission lines, and the critical electrical interconnections that bring megawatts of capacity from the power plant to the data center door. Recently acquired Cupertino Electric to add specialized low-voltage data center electrical expertise. Even if Constellation Energy builds a nuclear plant and generates 500 megawatts, someone needs to build the transmission lines and electrical infrastructure to deliver that power to the data center campus. Quanta does exactly that. $44 billion backlog means years of committed work. Company number 9, Modine Manufacturing, ticker MOD. Bottleneck, cooling and emerging liquid cooling specialist. Framework score, 28 out of 40. Market cap approximately 6 billion. Data center sales rose 31% sequentially in Q3 fiscal year 2026. Order book extends approximately 5 years out. Management expects 50 to 70% annual growth in their data center business over the next 2 fiscal years. And critically, Modine is spinning off its legacy automotive thermal unit via a reverse Morris Trust transaction, with Gentherm expected to close in Q4 2026. What remains will be a pure-play climate solutions company focused entirely on data center cooling. 5-year order book, 50 to 70% annual growth guidance. Spinning off legacy business to become pure play. This is a $6 billion company that could become 30 billion plus if liquid cooling becomes the universal standard for AI data centers. Company number 10, Xylem, ticker Xyl. Bottleneck, water infrastructure. Framework score, 24 out of 40, the lowest established score on the list. Market cap approximately 30 billion. Revenue over 8 billion. Xylem is the global water infrastructure company building water treatment and recycling systems for hyperscaler data centers. The lower score reflects the fragmented water infrastructure market, where Xylem has good positioning but no monopoly. However, the underlying problem is real. Hyperscalers are hitting fresh water limits in Arizona, Texas, and California. If municipalities start denying water permits to data centers, which is already beginning to happen, Xylem's closed-loop water recycling technology becomes mandatory, not optional. 3 emerging small-cap companies that could become multi-billion-dollar winners. Higher risk than the established 10, but significantly higher potential upside. These are the companies that could 10x from here. Emerging play number 1, nVent Electric, ticker NVT. Bottleneck, cooling distribution. Market cap approximately 12 billion. nVent specializes in liquid cooling distribution and intelligent power distribution units specifically designed for high-density AI racks. Organic orders surged approximately 65% in Q3 2025, driven almost entirely by large liquid cooling orders from hyperscaler programs. nVent has over a decade of experience in liquid cooling and has deployed more than 1 gigawatt of cooling capacity. They are more specialized than Vertiv in the liquid-to-rack distribution layer. Vertiv makes the large cooling distribution units. nVent distributes the cooled liquid to each individual rack and manages the thermal interface at the chip level. Nobody is talking about this company yet in the retail investment community. Orders surging 65% tells you the hyperscalers already know about them. Emerging play number 2. MYR Group, ticker MYRG. Bottleneck, power and electrical infrastructure. Market cap approximately $3 billion, near record $2.66 billion backlog. MYR Group builds the physical electrical infrastructure specifically needed for data centers, power lines, substations, electrical conduits, and high voltage connections. Profit margins expanding to 5 to 7.5% in 2026, driven specifically by high demand data center work. The stock is already up 277% over 5 years, but may not yet fully reflect the acceleration in data center electrical construction demand. $3 billion market cap with a $2.66 billion backlog building electrical infrastructure for AI data centers. The backlog is almost equal to the entire market capitalization. That ratio tells you the market may not be fully pricing the growth. Emerging play number 3, Astera Labs, ticker ALAB. Bottleneck, networking and intelligent connectivity. Newer IPO company. Astera Labs makes intelligent connectivity solutions specifically for AI data centers, including smart cables, retimers, and fabric switches that solve the data movement bottleneck between GPUs. They are solving the exact problem of GPUs sitting idle 80% of the time, waiting for data to arrive. As GPU clusters scale from 10,000 to 100,000 to 1 million GPUs, the connectivity layer between them becomes the binding bottleneck. Astera Labs makes the smart components that ensure data moves at maximum speed with minimum latency. If Arista Networks is the highway and Coherent is the asphalt, Astera Labs is the intelligent traffic management system that ensures data flows without congestion or jams. Early stage but positioned at the exact bottleneck that scales with AI cluster size. Why AI model companies fail the framework. Monopoly, 1 to 2 out of 10 because there are 4+ competitors producing functionally identical outputs. Backlog, 1 out of 10 because revenue is spot market monthly subscriptions with no committed future revenue. Customer lock-in, 2 out of 10 because users and enterprises switch freely between models. Capex flow-through, 3 out of 10 because only approximately 5% of the $725 billion in AI capex actually flows to model companies. Total, 7 to 8 out of 40. Model companies are below the threshold. They are not infrastructure plays. They are consumer products in a price war with compressing margins. Why Nvidia scores lower than most people expect. In 2023, Nvidia would have scored 35 out of 40 with a genuine GPU monopoly. In 2026, the scores declined to 25 to 28 out of 40. The monopoly is eroding, AMD's MI300X is competitive, and Google, Meta, Amazon, and Microsoft are all building custom AI chips for their own infrastructure. Gross margins are compressing from the peak of 75% toward 55 to 60% as competition intensifies. At $3 trillion plus market cap and 40 plus times earnings, Nvidia is priced for perfection with a declining moat. Nvidia is still a great company, but at current valuation with an eroding competitive position, the risk reward is worse than the infrastructure bottleneck companies that are cheaper, smaller, and have deeper moats. These 13 companies are not the only ones solving AI bottlenecks. There are dozens more across all 5 categories. Here is exactly how you can use the 4-metric framework to find additional companies yourself. Step 1. Pick a bottleneck. Chips, cooling, water, power, or networking. Step 2. Search for the supply chain of that specific bottleneck. Search for AI data center followed by the bottleneck keyword followed by supply chain companies. Example, AI data center liquid cooling supply chain companies. You will find lists of public and private companies at various stages solving that problem. Step 3. For each company you find, check the key financial data, market cap, revenue growth rate, gross margins, and order backlog. The backlog is usually disclosed in quarterly earnings calls or annual 10K SEC filings. Score each company on the 4 metrics using this publicly available data. Step 4. Look for SEC filings on sec.gov. Search the company name and read the 10K and 10Q filings. The risk factors and business overview sections give you clues about the competitive moat and market position. Step 5. Check quarterly earnings call transcripts, which are free on financial sites or the company's own investor relations page. Search the transcript for keywords like backlog, order book, data center, AI, and hyperscaler. These keywords will tell you how much of the company's business is tied to AI infrastructure. Step 6. Score the company using the 4-metric framework. If it scores 30 plus, do a deep dive on the financials. If 25 to 29, put it on a watch list and monitor. If below 25, skip it unless you have a specific thesis. The framework is the tool. SEC filings and earnings call transcripts are the data source. You can evaluate any AI infrastructure company in 30 minutes using this method. Additional companies worth researching that I did not cover in depth. Schneider Electric for combined power and cooling solutions. Munters for evaporative cooling technology. Parker Hannifin for quick disconnect couplings, which are essential specialized fittings for liquid cooling systems. Celestica for GPU rack level assembly, particularly as Google's primary TPU assembly partner. Digital Realty and Equinix as data center REITs leasing space at premium pricing to hyperscalers. Use the framework. Score them across all 4 metrics. Some of these could score 30 plus and belong on your own investment list alongside the 13 I covered today. Investment strategy by risk profile. Conservative, 70% core and 30% secondary. Core holdings in ASML, Constellation Energy, and Arista Networks. Secondary holdings in Vertiv, Eaton, and Synopsys. Skip emerging plays entirely. Expected return, 8 to 15% annually over 5 years. Moderate, 50% core, 30% secondary, 20% emerging. Add Coherent, Quanta Services, and Modine +1 emerging small cap pick. Expected return, 12 to 20% annually. Aggressive, 40% core, 30% secondary, 30% emerging. The full list including nVent Electric, MYR Group, and Astera Labs. Accept higher volatility and potential drawdowns for the chance at multibagger returns from the emerging plays. Expected return, 15 to 30% annually if the emerging plays succeed. Remember that higher expected returns come with proportionally higher risk. The verdict. Phase 1 of AI from 2017 to 2023. Nvidia won. GPU monopoly. Everyone bought Nvidia. That trade is largely done at current valuations. Phase 2 from 2024 to 2030, the bottleneck companies win. Cooling, power, networking, and chips infrastructure. $725 billion in annual capex flowing directly to these companies. The 4-metric framework identifies the winners. Score 30 plus equals serious investment. The 13 stocks ranked: ASML 40, Constellation 38, Arista 37, Coherent 35, Vertiv 34, Eaton 32, Synopsys 31, Quanta 30, Modine 28, Xylem 24, plus 3 emerging plays in nVent, MYR Group, and Astera Labs, plus the framework itself so you can find dozens more on your own. The next wave of AI multimillionaires will not invest in AI models. They will invest in the companies building the roads, the cooling systems, the power plants, and the optical connections that AI literally cannot exist without. 13 companies. 5 bottlenecks. 1 framework. Which bottleneck do you think will be the most profitable by 2030? Drop your pick in the comments with the company you think wins. I will score it using the 4-metric framework. Hit subscribe. See you next week.